Most traders use indicators completely wrong. They stack them, they tweak their settings, and they use them for signals, and they wonder why the results are inconsistent. Now, I don't use indicators to tell me when to buy or sell. I use them for context. This isn't about finding magic entries. This is about understanding where you are in the market so you stop forcing trades and make more educated theses towards the trades that you do take. So everything I'm about to show you is completely free, built into TradingView, and it works across swing trading, options, or just regular trading in general. Welcome back to another video, guys. If you guys aren't followed EntryPilot IG, I would go do that right now because we did give away $100 to someone who commented on the last video. So congratulations, Zach. You've been DM'd. Let me get you that money, and then we can maybe run that again on this video. But hopping into this, let's jump straight in. The problem with how most people use indicators is they treat them like decision makers. So explain very simply, if you were using the EMA and the EMA says, you know, this is a good time to buy, you're just straight up buying. If you were using a MACD and the MACD crosses, you're chasing a trade. If an indicator disagreed with you, you're probably panicking or not taking the trade that you liked in the first place. The problem is the indicators don't understand context in the markets. They don't know if you're in a trend, they don't know if you're in a range, they don't know if you're in drawdown, and they don't care if you're in a distribution phase in the market. So the key thing here is if your indicator is your strategy, you do not have a strategy. So my philosophy with this is indicators are used as context. They're not signals. Price tells me what is happening, and indicators help me decide if I should care. So I'm not taking entries off indicators. I'm using them to frame better decisions for my swing trades, my cash secured puts, and my covered calls. And that is the difference. So I want to break down the indicators that I actually use and how I use them and help you guys better understand how you can use indicators for context and not your overall decisions in the markets. So these are the three that I use. I'm going to break down each of them one by one. The first one's going to be the pivots, high and lows. This is just these right here on my chart. All pivot high and lows do is mark out key swing highs and swing lows on the chart with prices. They visually show you where price is and where it has reacted from before, and I don't really have to rely on looking at the right side of my screen all the time. And if I put my mouse right here and I'm moving it around, you can see how the price changes on the right side, but with it anchored like this, it does just give me a better visual cue to use. There's nothing more to it than that. That is very, very simple. That's it. That's why I like them. Now, the reason I use this is because it shows real price memory, as you can see right here. It highlights important levels without me having to guess, and it just removes that overall emotional bias and having to always look at the right side of my screen. This is just a major convenience for me, just seeing it right on the chart. I can see how we've interacted at past levels, you know, where we've been and, you know, maybe where we're going. Now, to use this for cash secured puts, these are just levels that help me choose my strike prices at. Like I can see right now on Airbnb is the ticker we're using. If I was looking to pick something up, you know, at the 110 level, I can see 110 is right here, 115 is here, but I can see that this is a major low that was back in November. So I would be looking to pick something up in these areas right here, and I know that I'd be looking for a 115 to a 110 strike price. That is very simply it. There is nothing more complicated to it than that. This just gives me the context I need and a bit of a visual cue to understand where I would be placing a trade from. Again, on the upside with covered calls, same thing, going back to the upside. If I was looking to exit a trade with a covered call, I just see where price has been, and that does give me a good idea of where I can be trading from. As you can see, like 141 looks like the high here, but if we zoom out, we can see that Airbnb was a lot higher, touching all the way up at 170 without me having to look at the right side of my screen. So if I was looking for a key point to sell it at, I can kind of just use, you see 143, 141, and there's all this gap in between before those highs again. So it gives me a good idea for framing and like more of a visual cue to see that. Now, the next indicator that is probably the most important one out of the three is going to be my support and resistance indicator. Instead of me having to draw all these lines on the chart, this one obviously just autofills it for me. It just maps out support and resistance zones automatically. It is nothing fancy. It is just visual organization. The reason I use this is because it shows me where my support and resistance levels are, and it helps me frame probability instead of my precision mostly. It keeps me from forcing trades in the middle of ranges. Like if we broke below this support, it doesn't look like there's anything down here. So if we kind of did something where we dip below these and we kept falling, it would look to me that we are in a bit of a free fall scenario instead of actually being able to, you know, hit a support level and recover. And the same thing applies if I was trading to the upside. If I saw a resistance level like right here and I was trading to the upside, I could sell a covered call right here because I would anticipate maybe a bounce back down below before coming to the next level where I could sell one up here. So it does give me a really good bit of context, especially for cash secured puts and covered calls, because it shows me where price has a high probability of reacting off of. In a case like this where we're at a support zone right now, I would expect us to continue to trail up like I've marked out here. But if we break through this support, I would hope this support holds this level. And if it doesn't, then this is where I would, skew my bias to, instead of bullish, I would think we're going bearish. But if price is like in this range right here, this is exactly, why I use this. I can visually see where price is. I can see how it's reacting and, maybe where it wants to go. I can take a good educated guess to help me frame some of my trades. Now for cash secured puts, I always want my strike at key support levels or like just above them. Personally, I don't like when my strike prices go below them, so I would put a cash secured put at the 121 level. Unfortunately, we are trading right there right now, so I would look for from the 116 level, anywhere in between 116 to 121. Now, this whole zone is fair game for me because we are in between two levels of support. So I do think price will kind of play in this area before having a move back to the upside. Obviously, we do have earnings on Airbnb. That's going to be very cautious for me. But if I was taking a cash secured put, but we're just using this for an example right now. But if we have two support areas like this that I can visually see and that we've respected in the past, this is what makes me confident where I can say, look, these are great levels of support that I could take a swing trade off of, that if we did come lower, we grab the stock at a much more premium price, and then we can let this play out over the longer period of time, make a good percent gain on the stock, and make a good covered call premium. And on the upside, I like using covered calls with resistance zones. These are perfect for pairing together strike prices for exiting trades, just because you do expect price to react, bullish off of support. You expect price to react bearish off resistance levels. So what I would be doing was I would be looking to place my entry for one of these, whether it's a swing trade or a cash secured put. I'm looking to put it in between, support zones like this. When we inevitably bounce off of this, if I'm happy with taking gains here, this is where my covered call would go, because this is where I would expect price to bounce, have some reactions, maybe dip a little bit lower before coming back to the upside. So depending on how confident I am in certain zones, I can either sell right here, or I can set it up here, or even right here. Now there's all these resistance levels up and up and up. So it really does depend on, where I feel like selling, what percent gain I'm targeting, along with the covered call percentage. Now, finally, the last indicator I use is the 9 EMA. This is probably like the one indicator that everybody uses no matter what they're trading. The 9 EMA just shows where price is trading relative to short-term momentum. I don't use it at all for a buy or sell signal. I usually use this to help identify trend versus chop, and it keeps me from fighting momentum, and it kind of simplifies my decision making, because if price is consistently above it, that tells me something. If price is consistently whipping through it to the downside, that also gives me a pretty clear direction. If we are way far off the EMAs, if the EMAs were, not like following like this and we were trading way below it, I would expect that we would have a bit of a correction back to that price, that I can see how it's reacting, if it wants to continue down, or if it's going to go, flip the EMA, go to the upside. But it's more so just for a really good bit of context where I can visually see where price is trading. Are we chopping like right here? We were just staying right in between the EMAs, versus right here where we were just respecting it, taking it all the way to the upside, or even right here where we were respecting it, but hitting all the way to the downside. Now, tying this into my cash secured puts and covered calls, if price is extended far above the EMA, I'm way more consistent with my cash secured puts, because I can choose strikes farther out and let price come back to me. With covered calls, if price is struggling below an EMA, that's often when calls would make more sense, because we would see that recovery back to the upside where I would inevitably grab that covered call premium and sell the shares at that level. For swing trades, EMA is mostly helping me stay aligned with the dominant move, which way is price moving, and I'm not really fighting the market. I'm kind of just following along. Like right here, you can see we have been very bullish, and we're just respecting this EMA so perfectly. The 9 EMA is just the best EMA to use personally. It really does give such a good context if you know how to use it. I'm not trying to outsmart momentum here. I'm just trying to understand which way the momentum is going, and the 9 EMA is so perfect for that. This applies to swing trading, option selling, trading, day trading, whatever kind of trading you do, the 9 EMA is such a powerful tool. And personally, I think one of the most powerful tools in day trading is actually the 9 and the 18 EMA together. That is just a nasty combination for entries if you already have a good daily bias, but can save that for another video. But that is completely it. That's it. 3 indicators is all it takes for me. I just help it frame and give myself context towards my trades. They don't tell me what to do. There's no alerts, no buy and sell arrows. They are not here to tell me what to do. They're just here to stop me from doing dumb things with the market. It just helps me frame a good context to what the market's doing, and it helps me frame better trades as a trader. If you need 5 indicators to take a trade, you probably shouldn't be taking the trade if it's telling you to do anything. There is that one saying from the Einstein of Wall Street where if your trading chart looks like air traffic control on 9/11, you definitely got a problem. And I do heavily agree with that. I do see traders with insane amounts of indicators on their screen, and it's just overkill. Like, it looks like a crime scene investigation. So honestly, I can definitely recommend using these 3 because for swing trading or options selling, this is all you're ever going to need. It's all about context. It's all about, framing the correct thesis for a trade. Other than that, the only person clicking buy or sell should be you, not the indicators. This setup works because my strategies don't require perfect entries though. Options reward patience and positioning. Swing trading rewards structure and the context. So the indicators help me slow down, choose better spots for those entries, and I just kind of let time do the work instead of stressing out over the perfect entry. Indicators aren't the problem. The people that use them are. So if you stop looking for signals and start looking for context, your trading will change. And obviously, trade less, position yourself better, let time do the heavy lifting, and that's what I do instead. If you guys want me to review any indicators, I'm more than happy to do that. Like I said, I'm a very simple guy. I really only use 3 indicators for the vast majority of trading. There really is nothing more to it. You guys have seen a lot of my trades now. I'm very sniper with my entries. I'm very good with the options positioning now that I've been doing this for so long that it really is not about that perfect entry. It is, having the right framing, the right thesis for the trade. 90% of the work should be done. The last 10% is just clicking buy, putting a TP, putting an SL. That's really it. But if you guys found value in this video, make sure to leave a like, subscribe, leave a comment with any questions you might have. And with that, we'll see you guys in the next one.